when you're doing that, you're basically just a fee developer. So most institutions want some real money coming to the table.
I would just add one thing. I think Jeff sort of alluded to it, but I think you have to know who's the holder of the debt and what their motivations are, because I think that the motivations of who holds the debt are very different if it's European banks versus U.S. banks versus a small bank versus a large bank. Where are they? Versus a finance company. Totally different depending upon, and even in the special servicing world, totally different depending where their B piece might be in the stack.
Okay.
Also, if it's an opportunity fund, that's a much different discussion.
What would that discussion be like?
Probably the reason that they're holding that piece of paper is because they want your property.
Yeah, right.
And, so, I mean, that could make it a much tougher discussion.
You know anyone like that? I'm sorry, that wasn't true.
The world's round, so.
All right, so we've got this, we've got new capital coming in, this sort of rescue capital. How's it being priced? No one's going to throw good money after bad. How do you get your money out? How's it being priced? Talk us through it.
If it's new money coming in, I think that, and again, it depends upon the asset class, depends upon the risk in the asset class, but I think the new money is looking for anywhere of a low of 15 to a high of starting at a 2.
I agree with that.
An IRR.
Okay. Note purchases. David, are any, how are these things getting capitalized? Lenders lending against these, or?
Periodically, most of our transactions are all cash at closing. There may be a lender in the background. It's kind of rare these days for the smaller guy to be buying distressed assets on a heavily levered basis. I think as you get larger and the play turns a little less from a kind of a real estate centric play and a little more into a financial play, then the leverage becomes more prevalent.
Okay. Claudia, are you willing to lend on note purchases?
It depends. I think what you'll find is obviously there are debt funds out there. I think players like GE are probably financing notes, but what's interesting is the banks are getting back into it, and I think what we've seen here in this cycle is, as someone mentioned before, is local banks are stepping into a role, and again I think they will, we will and other local banks will finance note purchases. I mean, obviously it depends on the jurisdiction. How quickly can you get to the real estate? The sponsor has to have some real capital in the deal, or capital available if they do get to the real estate and it needs additional TI dollars or CapEx. But what we're seeing is a lot of these deals can be attractive, per the example I gave earlier, because the asset basis is being reset.
Right.
And so when you're getting a downtown office building at a significant discount to replacement, and really in some cases what a lot of the players here would say is a significant discount to the real value of the asset, that becomes a very attractive financing play.
Okay. Hey, David Geltner's slides were very interesting. They showed, particularly for maybe the more trophy-type assets, bounces in value of 30% since the trough. Where are we in the cycle? Has the market come back too fast? Are the best opportunities gone? Where are we right now?
I think there's a lot still to come. So from the standpoint of when you look at just, I saw one indication that the distressed real estate market is like $300 billion. And that's probably just a number based on the debt amount. So when you think of the fact that so many different financial institutions have such a magnitude of distressed debt on their books still, it feels like there's still a lot yet to be digested.
Okay. Paul?
My sense is that values in many cases have gotten ahead of fundamentals, clearly. That happened the last time. That might be just fine as long as fundamentals fall in under it. But yet we're just beginning, in my mind, the real times when, Rogoff and Reinhardt did a great study of what happens after these great events. And what they said is, in all things, is that it took 2 years after the event before you really started to digest and deal with the issues. And I think we're at the beginning of that cycle. And I think the next 2 years are going to be incredible opportunity years. There's going to be a lot of product available. There will be a lot of capital. It won't be a back the truck up world. But I think that my own belief is we're 20% of the way into the opportunities that are going to be available over the next 2 to 3 years.
Okay. Jeff?
I agree wholeheartedly with what Paul just said. I think, from a capital market point of view, real estate is clearly off the bottom. It's actually crazy in some ways, some of the auctions that we're seeing and how competitive they are. But also, being an owner and a manager of 15 million square feet, I can tell you flat out that the fundamentals are nowhere near, the levels that the capital markets are. So, I mean, we're just, we're not seeing like deterioration in the market, but we're not seeing any real growth either. So, there's a bit of a disconnect, and I think a fair amount of catching up that needs to take place.
All right. David, from the DebtX perspective, what do you think?
Well, the end of the world trade is clearly over. The buy it and sort of wait and catch the bounce, that's clearly over. That said, there's going to be a lot of product, both debt and equity, that are going to be sold. I think it's going to be maybe more of an operational sort of look at 100 deals to see one or two that you think are interesting, and much more of a grinded out business. But certainly the sheer volume of product that will be out there will create a lot of opportunity, kind of depending on the space you want to play in.
Okay. We've got 4 pretty smart panelists up here, right? So here's my question to you 4 smart panelists. In terms of, sort of conventional wisdom, everything we hear about in the market and you hear about, what are people in the market right now not thinking about that they should be thinking about? Let's go to Mr. Smirky.
Thanks so much.
You're welcome.
We call it IIR. Not IR, but IIR. Interest rates, inflation, and rebasising. Interest rates being simple, we're at a 50-year all-time low or close to it in 10-year rates. How long can the Fed keep it down? What's going to happen when the economy continues along? What is the real interest rate going to be? What's the real 10-year rate going to be? And what does all that mean? So that's number 1. Number 2 is inflation. What is it really? And you could go anywhere from what the 4th quarter GDP BEA inflation rate they assumed in the GDP was 0.4%. The government's numbers are somewhere around 2. But if you go to PPI and CPI over the last 3 months, you go anywhere from 5 to high of 12. So what is the real inflation rate? And what will it be? And number 3 is rebasising, which I think is the one thing that people really need to keep an eye on. Think of one market. It's about a 9 million square foot office market in the Northeast. This is a little smaller market. Its rents have stayed up during this downturn, even with higher vacancy, and that's predominantly because most of the vacancy was not leasable vacancy because of where they were in their capital structure. Right now, between 1.5 and 2 million square feet of vacant space we believe is going to come online into the market in the next 9 months. What's going to happen to rents in that market when there's not a lot of job growth and all of a sudden 2 million square feet of rebasis assets comes online and starts to compete for tenants? Those are the 3 things that I know.
Okay. Jeff?
I would agree with all 3 of those things. Maybe just a little more, granular here today now. What I think that people aren't really factoring in on the buy side is risk. I think risk is being mispriced in the in the distressed debt world. I think people are just sort of ignoring A, fundamentals, B, the legal documents, and yeah, I think people are going to get burned. I think you've got, what I've seen recently, just kind of being active in the market, is you've just got a number of players, be them hedge funds or funds that just don't have a lot of experience in the capital markets and dealing with things like participation agreements, intercreditor agreements, bankruptcy, A note, B note, mezz, all that stuff. Just paying, it's almost like, there's a premium to buy the debt as opposed to the property in some cases. So to me, it's just kind of crazy. And so I think that the market's just become a little bit blind to some of the underlying risks. And I think beyond that, there's just, way too much capital chasing, way too few deals. And, you got to be careful when that happens.
Do you think people are underestimating the costs of actually getting control of the asset, getting to their end game?
They're underestimating the cost and the time. Time being, maybe even a bigger factor in terms of what can happen to your returns.
Yep.
So you really got to take all that into consideration.
One of the top people at one of the special services in the country I was having dinner with about 3 weeks ago, and his comment to me was, and they know all pieces of the stack, they said the CMBS pieces that they were looking at were valued at 10% more than what they believed the loans they could sell for. So that was 10. So the further away you got from the asset, the higher the value. The CMBS pieces were 10% more than the loans. The loans were 10%, were trading for 10% more than REO, and the REO was trading for 10% more, they thought, than what the real estate was really worth. So the further you got away from the asset, the more mispriced it got. And I'll just say one other thing. So the new CMBS deals, this was told me last week at a Prudential Investor Conference, a major lawyer who's doing all the CMBS deals said that they had prepared all the packages and were going out and pricing the new CMBS B pieces, and they provided all this detailed due diligence and everything on every asset. They put it on a computer, they got it all ready to go. People came in and bid on the B pieces, 4 different bidders. Nobody downloaded one piece of any of the information to underwrite the asset.
It's a great country. Claudia. What are people in the market not focusing on from your standpoint that they should be?
I'm just a banker, so I'm the dumb one on this panel. I mean, we're very focused on interest rate risk, and every time we look at a deal, we have the current rate and we do a stress rate, but I just worry that the stress rate we're looking at in 2 years' time or 3 years' time when some of these deals come up is not going to be high enough. And then I also worry about the backlog in this system and institutions that like an Anglo-Irish. What's going to happen with that huge, what was it, a $15 billion portfolio?
Just tell them they need to sell. Okay, they got to sell.
12 billion.
But at some point, I mean, I don't think the Irish government can be patient, and they're going to have to do something with all that debt, and what's that going to mean? Particularly in a market like Boston, where they were very active, and suddenly you have all that paper or all that real estate coming to the market, and I think it's gonna have a really negative effect on asset values.
All right. David?
Well, I would add to that Maiden Lane. I mean, Maiden Lane is, 60, 70 billion? And it's a hodgepodge of assets, but eventually that has to hit the street. I think about, keeps me up at night every once in a while is just kind of risk. And the market has been, and not just real estate, but all asset classes seem to have been incredibly resilient in the face of sort of geopolitical risks, wars, natural disasters, all things that if you'd asked me a couple of years ago, I would have said, okay, there's the tipping point. Okay, there's the tipping point. Okay, there's the tipping point. And the market has been just incredibly resilient, and I just kind of wonder, like, how long is this going to continue?